you know, Garquake, really does a wonderful job in helping out the common man.
Yeah, no, it's been good. It's been good discussion so far on Twitter, and I've been getting a lot of data points that I missed because I used to not have an account and I would just follow certain names like Javier Blas and HFI and stuff. But now that I'm actually on there, I'm seeing a lot of people who I missed, and they're posting excellent information and data points. So
yeah, I mean, sometimes Josh says it all the time. I can't believe this app is free. Just really, just it hasn't been good for Twitter shareholders. It's been great. It's been great for the users.
Yeah, no, certainly. No, I'll slowly get on there, start posting stuff. It seems like people are posting a lot of content, so that's the one thing that's different than LinkedIn, where you only post, let's say, once a week or once every couple of weeks, and then Twitter is like almost, you got to be pretty active on there and posting multiple times a day. So yeah, it's a lot more dynamic social media.
Yeah, and to be able to also have that back and forth conversation in real time is just, and it's just, it feels like because there's so much, things going on, it doesn't feel like, that you're overwhelming, like it's just, it's a conversation. People can, it's like a popcorn, conversation, right? Just people come in, add their 2 cents, leave, and as you go. Whereas LinkedIn is just the focus on Twitter is on speed, and then Twitter it's accuracy, right?
Yeah.
But you can't really focus on accuracy if you're still developing your thoughts.
Exactly. No, well, yeah, we'll wait a few more minutes, and thanks everyone for joining. I see we got a few familiar names and some few new names, so that's really good to see. Yeah.
When did you first come across Surge, or like what brought it to your attention?
I've actually held Surge since, I want to say 2017 or 2016. It's been a long road. I had a bunch of shares in my TFSA and kind of been trading and held that for quite a while, and then coming earlier into this year, I had a big Athabasca position from last year, and we kind of sold that in January, late January, or I want to say February or March, and we're looking for plays which were totally undervalued, and Surge come up on the list again, and yeah, I think I ended up buying Pipestone at the time, but yeah, slowly started building Surge, and unfortunate that I kind of just bought right before all these deals and everything started happening. So it's been tough waiting, but I think we're seeing the rainbow, the jackpot at the end of the rainbow here. So we're looking good, and I think having that connection with Adam and him kind of displaying it to other investors and funds is also really good, because some of the people he mentioned on his LinkedIn post there were people who are managing investments for family offices and high net worth retail investors, and that's kind of more I think where Surge is looking to get eyes on them anyway. So yeah, that's been good, and the couple catalysts that we mentioned are coming up, so lots going on. Yeah, I've been hearing about the name a lot more on Twitter too, so whatever's been going on has been good. People are wanting to know more, which is awesome.
It's been
some of these mid-cap names.
Yes, I mean they just come up, and all of a sudden Brett's talking about it, a couple of other guys are talking about it, and then I attend the meeting with the one with the CEO, and again, you have to verify these claims, right? I haven't gotten a chance to. And that's why I'm super excited into, having going over the work you've been able to do on them, is to ensure. But based on what the gentleman was saying, there's so much to be excited about.
Yeah, no, certainly there's a lot of catalysts for the industry in general, and once you start really picking the stocks and doing deep dives, you can see where the potential really is, as we'll see um, here. So I think we can get started. I don't know who else is going to join, but yeah, but
Should
I
we
think
start with the introduction, Shubham?
um, introduction of everyone, you think, or
Yeah, because there's a lot of new guys that came in, from Twitter and Twitter land.
sure, yeah, let's do that. We got a small enough group here, so yeah, so we can kind of
Shubham.
go. Hello.
Hi, Shubham. This is Sharif. Sorry for being late.
Yeah, no worries at all. Good to see you.
Looking good, buddy? Okay.
Appreciate it. Yeah, I think we got a smaller group, so maybe we can just go around and kind of what you do, who you work for, or a little bit about your investment background, I guess. A lot of my stuff is on LinkedIn. I think some of you know me already, but Shubham Garg. I've been doing oil and gas stocks now since 2013, so been just over 8 years. I'll explain a little bit about how I do things, how I value my stuff here in this course, and my education background is in petroleum engineering and working right in the field, operating wells, doing maintenance, doing production optimization, field engineering. So yeah. So I hope to offer a little bit of a unique insight into companies and their operations, and then with our connections to management and our network
You
in the
are.
industry.
You're very too.
Here.
Hope to help out with that
Hey,
and
but,
insight and contribute back to the industry. Sure. So yeah, do you want to go
Sure.
next?
My name is Sohaib Abbas. I'm working on a accounting and finance degree. This is my last year. I got, I've started a business initially in 2014. Most of my clients were oil and gas clients. And, when they crumbled, I felt the effects of it about, 2 years down the road. And, just I've seen the misery in the sector. So I've always been really passionate about what we had. And 2020, in about April, May, I had the time to really, roll up my sleeves and look into it. So that's when I initially started deploying capital. And that's my story. And we'll have the next person that's willing to go up.
Hey everyone, my name is Cole. I work with the Canadian Integrated Oil and Gas Company. I'm primarily here today to learn more about what to look for when analyzing company earning announcements.
Right on. Glad to have you join us.
My name is Brett Pardell. I was formerly electrical engineer. I did a lot of work in Lloydminster, Fort Mac, Edmonton. So not too much oil field work, but power for these sites. So I gained kind of a liking for the patch in 2018, and then kind of went all in January 2021. So and now I have a financial planning business as well. So we don't invest too much clients into oil and gas because it's based out of Calgary, but we do buy 9 Point Canoe and Fidelity and Mackenzie commodity investments as well.
Hi guys, I'm Samir. Working in the oil and gas sector for almost 20 years in Alberta. And since 2018, I started investing in growth stocks. I'm mostly technical analyst. I do technical analysis a lot, and I found that there is some pattern forming in WTI. So started following some Canadian oil and gas industries, and as far as the pattern, it really looks good, and looking forward for some financial information.
Right on. Awesome.
I'm Trevor Metter. I've worked in oil and gas. I have a petroleum engineering degree, primarily worked on the completions, production, workover side of the business. currently am a sales manager at Precision. I started investing in oil and gas probably in about 2011, but working in the industry, I really stuck to other areas to reduce my risk. And then kind of in mid 2020, I started, based on valuations, getting into a little bit of oil and gas investment. And with the risk of inflation here, I've really kind of targeted more commodity type stocks and interested to see what I can learn today.
Right on. Yeah, no, appreciate you joining in.
Yeah, maybe I can go next. Anil Garg here. I'm a project manager with the oil and gas company here in Calgary. I've been working with the oil sands for the last 15 years. And yeah, as a family, we have our personal investments into oil and gas, mostly Canadian oil and gas. So yeah, looking forward to hear from White Tundra on tips on financial analysis of small and medium stocks. Thanks.
Thank you.
All right, I'll go next then. I'm Sharif. I have a bachelor and master's degree in petroleum engineering. I have around 10 years of experience in the industry. Worked mostly internationally. Recently moved to Alberta and work for the oil and gas sector here in Calgary. I'm here to learn more about the financial analysis part, just to be able to pick these good candidates for investing in the small and mid-cap Canadian oil and gas. Thank you.
Awesome. Good to see you again, Sharif.
Likewise, buddy.
Okay, well, I don't know if anyone else wants to go, but we can get started. I think we have quite a few people here now. So it's awesome to see everyone. Thank you for making the time and coming to this. It's good to see, like I said, some new faces. I know some people attended the previous one, which was a test run one, very quick. This one is a little bit more detailed, and looking forward to that. A little bit of preamble, I guess, is we're still doing the testing on this. There might be some glitches, so just bear with us. There are 3 companies that I've picked for this one, just based on feedback and kind of what people had recommended. So it'll be Crescent Point, Cenovus, and then Hemisphere. After each company, we'll just stop and have a little Q&A period, make sure everyone's on the same page. And then the way it's structured is we go from kind of the easiest companies to evaluate to the hardest. Given that Crescent Point just had their Q3 results, we have brand new data, fresh data, so something to go off of. From a financial modeling standpoint, this course is very basic. It's kind of built for retail investors. So I know there's people on here who are have some experience in portfolio management and equity analysis. So you might find there's certain things that are maybe not exactly as they are in the professional space, and that's just so we have things a little bit easier for the new retail investors or people looking at doing just basic calculations and kind of comparing companies. From an oil and gas standpoint, the course is just a little bit above basic. So you do need to know a little bit about the kind of supply demand structure of oil, kind of where it comes from, but nothing too crazy. So I'm hoping everybody finds value in this. Feel free to stop me anytime. It's kind of a hands-on course where I will have a spreadsheet on my screen shared, and we'll just work through the numbers. I believe that's better than me just giving out data and then people don't know where to look for it or where it is. So yeah, any questions before we get started? No. So the topics that we're kind of going to be discussing today is the way that I invest in my portfolio personally, and the way that I invest in White Tundra's portfolio, which is to look at pricing, see where pricing is going, and we look a little bit about the macro outlook. So inventories, demand, supply, whatever data points we can find to look at overall trending, and then we value companies. And we look at companies, we go through their financials, we see their ratios and kind of what the fair value share price is, which is what we're going to calculate today. And you can just compare them. You know, if you see a company that's maybe higher potential and higher risk, maybe that's your investment mandate. Maybe you're looking for a low risk and a lower potential company. But what I've been finding over the last few months is that there are companies that are high potential and still low risk, which is a great place to be, as long as you believe the macro outlook of what's going on, and it's been looking really solid so far. So we'll start with the pricing. We look at American WTI pricing. We're at 7 to 8 year highs right now. We're at $83 a barrel. We hit 85 earlier this week. A little bit of consolidation phase seems to be the talk. We're seeing excellent Q3 results from companies, some of which are not reflecting in the share price and some are. So depending on the company's free cash flow plan, I think we're seeing immediate reactions versus more of a delayed reaction. On the Henry Hub side, which is your American natural gas, we're almost at a 12 to 13 year high. We seem to be having a lot of strength in the market, given European natural gas pricing, Asian LNG demand, and a lot of other stuff that I'll show here in the slides. When we come to our WCS chart, which is our Canadian heavy oil, this is a 4-year chart, I believe. We're looking at extremely strong pricing. And compared to, something to keep in mind is that compared to the 2010 to 2014 era of high WCS pricing, we are now getting about 25% higher pricing in terms of Canadian dollars, because back in that time, the Canadian dollar was on par with the American dollar. So that's an additional benefit. And then with inflation, $68 WCS now is really only somewhere between $55 to $60 WCS. So there's talk about, hey, higher oil price is gonna destruct demand, and yeah, there is a portion of that, but it's not to the same extent. We look at AECO pricing, which is Canadian natural gas. We see from a year ago, we see pricing is almost doubled for the next 6 months. From even a month ago, we're looking really, really strong. And this is a futures curve, so it shows the pricing into the future all the way up to 2025. One of the things that people should take note in this is what we call a backwardation of the curve, which means that the price today is much higher than the price into the future. And one of the biggest reasons for this happening is that customers are looking for supply right now. They want the gas right now. They don't want to wait years into the future. So this is really good in terms of a demand perspective. It shows that people are willing to pay the extra money today, sometimes significantly extra money for that commodity, as opposed to just waiting another 5 to 6 months. And a lot of that is also due to winter demand. Obviously, heating demand is going to be higher in the winter. In Canada, especially, as we know, due to some of the harsh winters. So from a macro outlook standpoint, we go into the inventories. The only inventories that are really transparent are the American inventories, because they release updates on a weekly basis. It's pretty reliable data, although some people might argue that it's generally accepted as pretty reliable standard of data. So on the left side, we have the US crude inventories, excluding their strategic petroleum reserve, which is a reserve that's meant to be used in terms of if you have a war situation, you have massive hurricanes that are blocking supply from coming in, you have some sort of issues. So we see that we're looking pretty good. We're at kind of the lower end of the 5-year range, in a time where inventories usually build. We're seeing not as big of builds, or we're seeing slight draws overall, and it's looking pretty good from that standpoint. On the right side, we have our total commercial petroleum inventories, so including the strategic petroleum reserve, and we see we're below the 5-year range already, and this is due to the strategic petroleum reserve being used for non-emergency uses, and the American government deciding to sell crude from the reserve, and that kind of taking a little bit of load off the regular inventories. So the point I'm trying to get across is that if the strategic petroleum reserve was at the same levels as it was in 2010 to 2014, our left side graph would be almost off the charts, with the amount of crude that we've drawn over the last few years. Are there any questions so far on any of these graphs or information?
Shabam, quick question, Anil here. So similar to the future pricing of the Canadian gas, is there a trend expected for the WCS in future years?
Yes, so basically any oil and gas right now is backwardated curves. People are looking to get the supplies right now. And WCS is kind of a strange commodity in that it's not really actively traded. So I don't have a futures curve to show you, but on the WTI American oil side, yeah, the curve is extremely backwardated, where we're seeing oil today worth almost $10 to $12 more than post-winter and into next year. So, you know, for somebody sitting on oil, they're thinking, hey, I can sell oil for more right now, and I don't have to pay the storage cost to store this oil for 6 months to a year. So, you know, that shows extremely strong demand, where people are willing to pay huge premiums today. So hopefully that answers your question.
Yeah, thanks.
Yeah. So we look at more on the demand side. On the left side, we have weekly US gasoline demand. This time of year is usually a little bit of a slower season for gasoline demand, as kids are back to school. People are kind of finished their summer road trips, but we're seeing exceptionally strong US gasoline demand this year, and this is updated weekly through Gas Buddy data. And you know, we saw the trend kind of going down post August, and then we're seeing it actually stick where it is and increasing in some cases. This graph is also not to scale, so the bottom is not at 0. It's actually at 8.5 million barrels roughly. So each individual bar is actually significant demand increase. And on the right side, you really see the exceptionally strong counter-seasonal demand. The red line is the number of flights worldwide in 2019. So again, same thing, people kind of finish their travels, so the demand goes down into the winter, but this year we're seeing it pick up into the winter, and we're not far below our 2019 levels. And early November, we see American flights opening back to Europe. We see a lot of flights going into Canada. So there's a lot of demand still to come on this basis. And, you know, our jet fuel supplies are at pretty seasonal averages. So if we see demand going up, well, we're going to be really pulling from inventories even more than we have already. And this presentation will be available. I can send it to whoever would like a copy after the seminar. On the left side here, we see American oil demand. We're almost back to American total petroleum demand. So we're seeing that we're almost back to 2018 and 2019 levels. In early May, we actually reached there. And then due to the Delta variant and a little bit of tightening restrictions, we're back below, but September and October are looking strong so far. On the right side, we see Chinese inventories for their oil supplies. And the key point to note here is between September and October, we've drawn roughly 35 million barrels. So China right now is sitting at a 1 million barrel a day supply shortfall in terms of their supply demand, which is extremely good to see. And Chinese demand is just going to continue to improve. So they're looking at a situation where they're going to be pulling barrels from the market. They're going to be pulling barrels from oil that's sitting on tankers offshore. So looking really strong from demand perspective.
Quick question.
Yep.
Quick question. What's the name? Shubham.
Yep.
So one of the things that that I've just been curious about. So this data right now from China. I mean, how reliable is this data?
The data released by the Chinese government is not all that reliable, in my opinion. This data itself is released by Kairos, which is one of the most reliable and accurate data monitoring out there for inventories. They have a whole bunch of satellite systems. They have people on the ground. So this data I would use as quite reliable data in my opinion. And anything coming out of Kairos, I would say is pretty reliable.
And then a quick follow-up question to that is we were getting news, this was a while back,
Yep.
that China was, in order to depress oil prices, they were selling from their own strategic reserves. So, I mean, if they're in a shortfall, what do you think they're selling from their own strategic reserves?
So basically the conundrum that China is in right now is that they need to pull 1 million barrels of market of extra supply, and that's selling at $80 to $85 a barrel. So they don't want to do that. So what they're doing is they go into their strategic reserves and they say, hey, maybe we can just pull oil from here right now, and we'll kind of watch the market and kind of see how it is. They don't want to derail their economy or cause any sort of demand destruction at this point. So this data is only till October. As we see our November and December data, I would assume that the strategic reserves number also starts coming down along with the commercial inventories.
Thank you.
Yeah, you betcha. Yeah, thanks for that question. So now the American supply side, which is kind of the biggest problem that people seem to focus on, which is, hey, oil's at $80. Like, yeah, the American companies are going to be back to their drill baby drill mantra, and they're gonna again ramp up production. And you look at your first graph, which is the number of American oil rigs working right now, and it's a 1-year chart, and people are starting to get worried. Like, hey, look at this, the rigs have almost doubled in a year, and oh my God, we're gonna have the shale revolution again. And then you look at the bottom graph, which is a 3-year graph. We are barely just over halfway to where we were pre-COVID. And for those that kind of keep track of the industry, there was a phase in September 2019 all the way to March 2020 where we're sitting at roughly 700 oil rigs, and American oil production was not increasing. So what that tells me is that at that time, we required roughly 700 rigs just to keep production flat. And look at where we are now. We're at 428. So, production might still go up a bit as new wells are being brought on, but on an overall basis, we're a long ways from just keeping production flat, let alone from having production increase. However, on the supply side, what companies are doing is that instead of drilling wells, they're completing wells that they've already drilled in the past. So that explains why production has not really tanked, even though drilling rigs have not come back yet. So on the left side here, we have US oily shale plays, and they had roughly 6,000 wells kind of this time last year, where they had already spent the money drilling these wells, but they hadn't completed them and got production out of them. So, you know, the slope on this line is absolutely incredible. We're at about 5% a month, 3 to 5% a month of DUCs, drilled uncompleted wells, are being completed, and they're really taken into this inventory. So from a more technical standpoint, a lot of these drilled uncompleted wells that are left, so the 4,000 wells that are left, a lot of them are never going to be completed because they're wells that the drilling was not done properly, or the formation caved in on itself, or they just didn't see the core oil saturation that they wanted. So, you know, we're getting pretty close to that place where a lot of the wells that are in this DUC area are not even economic anymore. So there's a big reckoning coming in that sense, where once this drilled uncompleted supply is less and less, we will see the lack of drilling rigs really come to the forefront, and production start to decline in a meaningful way in America, if they don't pick up any more rigs, which seems to be the trend. The demand, the import graph on the right side shows how much oil America imports on a net basis. So imports minus your exports since the 1970s. And the main point on this graph that I want to point out is on the far right end, which is that kind of in the pre-COVID period, America had started to become a net exporter of oil, where they were exporting roughly 1 to 1.5 million barrels a day of crude oil and petroleum products. And where are we now? We're back to the zero line. So just like China, America is in the same place, where they now are pulling an extra 1 million to 1.5 million barrels a day from the oil on the water and the oil on these tankers and from other sources. So we're seeing a big supply shortfall that may not be evident in the numbers that you see, but when you look at the overall global balance on the supply demand curve, we see 2 to 2.5 million barrels of shortfall just from America and China. And you know, when you add in the other countries that are growing and adding to demand, it's really setting up for quite a good run here as we go into the winter. The other problem that people mention to me often is, you know, hey, is it too late? I see XYZ company is already up 300 to 400% since the lows last year or 12 months ago. And that's what the graph on the left side shows, is that in the energy bull markets, we are just getting started. There's a long ways to go. The last few bull markets, we're still a 4x from our base index level to go. And the other thing to point out in this is that the oil bull market is not going to be a 3 to 6 month period. It's going to be a long lasting, a slow grind up. And basically the biggest question is with the way the markets are right now, are these timeframes going to be consolidated a bit? We're seeing changes happening a lot faster in the market than they used to. So, you know, potentially this could be a much more steep curve up. That's yet to be seen. But the main point is that there's still a long ways to go. And we'll see that in the valuation section as we go as to why stocks are still not reflecting the price right now. There's a question on the chat here about how much oil comes out of 100 rigs. That's it's not really a question I can answer with any accuracy at all. The main point that I'm trying to get across is that we needed 700 rigs to keep production flat, and we're at 425 right now. So in terms of how much oil would an extra 100 rigs add on, I don't really have an answer to that. I don't really want to speculate on that. But we're sitting well below the levels that are required to keep production flat. Is kind of the main point of that, and that's kind of where I do my data analysis, is on the trending and the outlook based on past performance, based on what I see in the future, because a lot of these questions as to the specific oil that can come out of certain rigs or certain wells is just too specific. The information is not reliable. The information is not available. So yeah, but thanks for asking that.
A quick follow-up on that,
Yeah.
Shubham. So the drilled but uncompleted wells. So would you be able to talk about what happens when those are exhausted? So once, you know, okay, they're okay, maybe a 30% formations aren't so great. We can't, you know, these are unviable, whatever. So once, you know, they reach the point where, okay, we're no longer, you know, moving forward with drilled but uncompleted wells. So what impact would that have on the production?
So basically I can only put this one way, which is that right now the difference in the rigs, like the fact that we're only at 425 compared to 700 required, and we're still maintaining US oil production, is basically due to the DUC count. There's an argument that can be made that, hey, because the wells, the rigs are more efficient and the wells are better acreage, and yeah, you can make that argument, but it doesn't account for the majority of the reasons. So once these DUC wells are exhausted, which is probably around between 2,000 to the 3,000 range, because that's the amount of wells that are basically uneconomic. Once we get to that, you will see that unless American rig counts really pick up, you will see production start to decline. As far as how much, I don't really know, but we can say that, hey, you know, if 700 rigs are required to keep production flat, and the average decline rate on these shale wells is you know, 70 to 80% in their first year, we can say that what we can say is that at 700 rigs, production is flat, and at 0 rigs, we're going to be losing roughly 5 to 6 million barrels a day, a year in our production. So, you know, 425 kind of puts us at just over half. So, you know, we can say that a year from now, American oil production is going to decline by roughly 1 million to 2 million barrels a day, if the rig count stays exactly where it is. And that's kind of the best extrapolation method that I can use, because we just have to go with the trend and see how things are going. So hopefully that gives you a little bit more clarity on kind of my thinking. It's not the only way of thinking. Like I said, some people figure that based on the rigs working right now are the most efficient rigs, and they can put out a much larger share of production. But I don't have any deep analysis to add on that part of things, unfortunately, right now, with the research I've done.
Perfect, thank you.
Hey, Shubham, there is a quick question on the worldwide supply of crude oil.
Mm-hmm.
So we know that the US supply is going to be depressed. It is not going to increase, and Canadian oil supply is almost going to stay the same.
Mm-hmm.
But how is the world oil supply projected? I mean, maybe more production by OPEC or any other countries. Can it just make this whole oil price increase scenario phase out?
Yeah, so great question, and I think a question that I get quite often on this topic. So the American supply, as we see, it is not really going to come back. The Canadian supply, there are a few projects here and there, but are not going to really add meaningfully.
Yeah.
The biggest growth segments are offshore Norway, where we see a lot of exploration being done, is offshore Guyana, where ExxonMobil and Hess have a big discovery. You can say that Kuwait and Iraq are adding barrels. So there is a little bit of supply there. Brazil is another one that's mentioned. But on the flip side, which is kind of what I focus on more so, is that, look, American supply is declining. Saudi Arabian inventories are declining. Their production capacity is not really what it is projected to be. And Josh Young with Bison Interest has a really good piece about that. So if you want to link on that, I can definitely give you that. That really goes into the depth of why the global spare capacity is not what it's advertised to be. And we see huge declines. We see Venezuela declining heavily. We see Mexican oil production watering out and them losing a lot of offshore barrels from their Kumalub field. And we see Kuwait and Saudi oil production after 60 years of these amazing reservoirs that they've produced from. We see structural problems with their with the amount of new wells that they're able to bring on, the new production they're able to bring on, and we see declines. We see a lot of the declines kind of. The new supply is not offsetting the declines fully. So if we're running into a place where worldwide supply demand is kind of the same, but your consumer demand is starting to increase a lot, we see the pull for the marginal barrel, which is the first barrel that people can buy that's not already spoken for. We see oil being priced at that, and given where we are right now, it's gonna be very, very tight going into the next 6 to 12 months and even into the winter time. With natural gas pricing being where it is, we see consumers switching from gasoline, from natural gas for heating purposes to switching to oil, which could add another 1 to 2 million barrels of demand this winter per day. So on the demand side, it's very strong. On the supply side, we do see new projects coming on, but they're nowhere near to offset the declining supply and the growing demand. So it's a very interesting time in energy markets where we're seeing a price increase in the value of energy, both due to increased demand and a lack of supply. So it sets us up for the possibility of some really big fireworks going forward.
Okay, thanks for the insight.
Yeah, you betcha. So the graph on the right here just shows you that the big oil, which are kind of the big five players, their free cash flow that we're seeing today is going to be higher than we saw during the $100 crude period in 2014. And some of the big reasons for that is because these companies have stopped spending on growth projects. So a lot of the cash that they were making is now free cash flow because they're not reinvesting it back into the business. And in addition to that, a lot of these companies have much lower operating costs and much lower operating break-evens than they did in 2014 when it was kind of the boom oil period. So the free cash flow that we're going to see in Q3 is going to be higher by a pretty big margin than 2014, as this graph kind of shows. So a lot of that free cash flow is going to be returned to shareholders in the way of dividends and share buybacks, and some might be reinvested into the corporation. but it's there, and it's up to shareholders to kind of tell the companies what they want. And we saw that this week with the difference in price reaction between Suncor's earnings and between Imperial Oil's earnings, and kind of what they say they're going to do with this free cash flow. So with all this macro outlook kind of in my mind, we're projecting, we're seeing higher oil pricing regime for the next little bit, and that's the way that we're going to kind of value our companies. We're going to look at what they're valued at today and what they're valued at $100 oil, what they're valued at even higher than that. So yeah, so I think, is there any questions so far on this before we get started on the actual exercise of the valuation? Nothing. Okay. Right on. So the way that I value these companies on a very basic level, when I start my deep insight into a company, is you only need to know a very few number of things, and they're all available on the Q3 results or their corporate presentation. So you need the production and the oil percentage, the number of shares outstanding, and the share price. You need the current debt. The debt capacity is optional if you want to know what kind of capacity the company has. You need to know the annual dividend is required. The annual capex is not as important. And you need your recent quarter adjusted funds flow and free cash flow, which are both in every Q3 report. They're in almost all the corporate presentations. And then once I'm done that, I kind of look at the hedging and what the hedging situation is. And after that, like, we can make it as complicated as you want. You can look at all kinds of factors on the company, but from a basic standpoint, this is really all you need. So let's go to our seminar calculations. Is everyone able to see this spreadsheet?
Yeah, we see it.
Yeah.
So the way that I kind of ran the initial test run was a little bit different than this one. I did send the files over on the email. So if you want, it's best to kind of follow along with the numbers that are being put in here, so that you really understand where they're coming from. And if you want to value a different company, you're able to do that. So we'll start with Crescent Point. So that part's pretty obvious. And whoever wants to follow along, what I would recommend is you open their Q3 results file that was in the email. So bear with me while I do that.
If anyone wants that joined in and didn't get the email, throw your emails up, and I'll have this template sent out. Did we lose you, Shubham?
No, I'm just opening the file here. Just give me 1 second. Cool, right on. So whoever's following along on the Q3 results, we have an updated we have an updated production number in here, which I'm just trying to find. So it's under operational highlights, kind of almost all the way down the first page. It's the first bullet point. It says Crescent Point's average third quarter production was 132,186 BOE. So maybe I'll wait a bit till everyone has this file open. I haven't sent the Excel file to everyone. It gets a little bit convoluted with this many people in the presentation and trying to find numbers and put them in at the same time. I can definitely send it to you after the seminar. Yeah, the way I was kind of going to run this one as a test was if you guys could follow along just based on the Q3 results and the PDF files, and then I can input the information and everyone can see it on this screen. If that works for everyone. Let's yeah, let's go with that for now, and then maybe after this one, if on the next Cenovus, one, if people want the Excel file, I can definitely share it. I think Sohaib already has it, so yeah, feel free to send it over if you have the emails as well. So the production we have was 132,186, and on the same bullet point, we see that it's comprised of 80% oil and liquids. So we're going to put our liquids percent at 80%. It'll calculate your liquids production, your gas production on its own. So anything that's in yellow has to be filled out. Anything that's orange is kind of like optional. You don't really need it, but it does help. Yeah, is everyone following along on this? Is this method working for everyone? Any comments on that?
Looks good, Shubham.
Cool. So you kind of need all the files open at the same time, which is, it's just going to depend on the company. Some companies are better at putting certain information in their corporate presentations. Some don't have all the information. So the other file that I have open is going to be the Crescent Point October presentation as well. And what we see in the presentation is, if we go to page 19 on the presentation, has a lot of the other information that we need. So the number of shares outstanding is on the table in the left side, 582.2 million. And the share price, I believe the closing price on Friday was 6.2 Canadian dollars a share. That's just available on any bank or on Google even. And the current debt would be your net debt, which is in the same table on page 19, which is 2.1 billion. So that's 2,100 million. And we get the spreadsheet that's calculated these numbers for us. So the market cap for any company is basically what all its shares combined are worth. So the total equity value of Crescent Point's shares is $3.6 billion, which is this number right here. And when you add the debt to that, we get an enterprise value, which is, what is the value of the company with its shares and its debt and its cash position and everything taken into account. So the entire company, if somebody was to buy it right now and the company's shareholders were to accept, it would be worth $5.7 billion. And we get a debt to EV ratio, which is your debt to enterprise value ratio. I just have a comment here about where the information is coming from. So let me just go back a bit here and share. So so this is a corporate presentation that I'm looking at. It's also in the files that was sent. And feel free to put your email in the chat if you haven't received it yet. But here we have the number of shares outstanding. We have our current share price. We have our net debt. Is all in this table. And this table actually gives you the market cap and enterprise value as well. But it's good to know how to calculate these yourself, because these presentations might be outdated. They might not be fully up to date. So so hopefully everyone is following along. Feel free to stop me at any time if there's something you're not understanding, or there's data that I'm putting in that you're not finding as well. So yeah, so let's head back to this. So our debt capacity will be, again, not all companies post this, and it's not exactly a make or break, but this is on page 11 of the Crescent Point presentation. We see a little bit about the debt structure and kind of what's going on. And the number you want to pick is the far left graph that says liquidity. So basically what the company is saying is, hey, we have more than $2 billion of debt that we can potentially take from the banks, but we haven't. So it's almost like a line of credit that they haven't taken any money out of. So the liquidity is 2,000 million, so 2 billion. And what we're going to do is our debt capacity then becomes our current debt plus what's not taken. So it would be this 2,100 plus the 2,000, so we get 4,100 is technically what the max debt that the company currently has available to it. And we get a debt utilization of 51%. So the company right now is about 50% of their debt capacity is what they're in right now. So pretty good number. The reason we calculate these numbers is not to value Crescent Point as a company. It's to compare Crescent Point to the following companies that are going to be that we're going to do the valuations on. So if you see a company with very high share price potential, but their debt utilization is like 99%, well, you know, now that's a high risk, high reward play. So so this debt to EV ratio and this debt utilization just compares companies. It's not used to value a specific company. So that's why these numbers are not that important, but it's good to have them. Our stay flat capital is basically the amount of money required for the company to keep its production flat. So its wells are going to decline over the year, and how much money do they need to put into the company to keep their production flat? And we go back to the presentation, and we go back to let's see here. Where is this information? So we can use this number here. We have on page 19 again, we have on the right table, we have capital expenditures, and we have development capital. We have there's usually other factors in there like asset retirement, well abandonments, etc. And we get a total range, which is about $650 million is what the company needs to stay flat. These are 2021 numbers. Crescent Point did a big acquisition in 2021, so this number is not 100% accurate. But again, it's in our orange zone, so it's not a make or break number. It's just good to know. And so that goes right there under stay flat capital. And the other thing we need is our annual dividend. Which is in our Q3 highlights. So we see page 2. Page 2 of the corporate presentation says their quarterly dividend is 3 cents a share. So their annual dividend becomes 12 cents a share based on that. So we'll throw that in there. And the spreadsheet will fill out all the other information. All we need to put in is the yellow boxes. Is everyone following along so far? Are there any questions at this point?
So the stay flat capital, did they mention that this capital is to keep production flat, or you infer this from the production outlook?
So this is on page 19 of the corporate presentation. Again, we go to the table on the right, and we see our 2021 guidance. And under capital expenditures, we go to the total row, and it's roughly 650 million. That's where I'm getting that number.
Sounds good.
Yeah.
Do you compare production in that outlook to next year and see if that capital is really not involving any growth in there, or if the company production is actually going down? Do you adjust that capital accordingly, or just take it as is?
Yeah. So I would adjust capital accordingly. Yes, in my calculations. And like we know, like Crescent Point did acquisition from Shell of the K-Bob Duvernay field. So I'm assuming they're going to be spending some more money on that. And I know Crescent Point has a number that they've put out for 2022 capital. It's just not in this presentation. So for the sake of simplicity, for our initial calculations, we don't really use capital expenditures anyway. So we'll just take this number. Once you want to do a deeper dive and really knock down the numbers, yes, you're absolutely correct. I would go and look at capital expenditures. I would look at any cost savings. I would look at, for example, inflation. The cost of steel has gone up a lot. The cost of oil field labor has gone up a lot. It's hard to even find people. So you can make your own deductions on that based on your own insight and your own experiences, but it doesn't affect the base calculation. So it's not something that I really spend a lot of time on when I'm doing my base share price valuation. So
thanks.
Yeah, you betcha. So what we need after this, we need our last quarter of adjusted funds flow, and we need our last quarter of free cash flow. So it's very nice to have a brand new, fresh Q3 report, because this information is right up to date. And if we go to our Q3 press release, which is the other file that was sent with the email, we see under financial highlights, we see our adjusted funds flow totaled $393.9 million, or 67 cents a share. So the adjusted funds flow is a number that how much money did the company generate before you take into account the dividend payment, before you take into account their capital expenditures, between you take into account their any other payments or any other acquisitions that they're doing. So this number we'll put in there as 394 million. And then we're looking for our free cash flow, which would be
Is it that up there in the second line? Over 180 million of excess cash flow, or that is not?
Yeah. So yeah, it's under key highlights, actually. Good point. Generated over $180 million of excess cash flow, which is the same as free cash flow. And if we go into the presentation, I believe, yeah, it says the same thing. So generated over 180 million. So, you know, we'll take that number and we'll put it in here as our last quarter free cash flow is 180 million. So that fills out a lot of our calculation as to what the share price is worth already, but there are a few things that are quite important to know, which is that your hedging impact is always in your free cash flow number. So when Crescent Point is saying that they generated $180 million of free cash flow, that's not really the actual number it generated, because the actual number of cash that you generate would be your free cash flow plus the amount of money that you gave back to shareholders as dividends, plus any loss from your hedging, because the hedging loss is only temporary. It's not going to continue on for forever. So you really want to add your hedging loss to your free cash flow, because as those hedges come off, we expect that the company will generate increased free cash flow. And we want to put that into our valuation, because we're evaluating these companies in the future, and to take a one-time or a temporary hedging loss into the equation would really skew the numbers, especially now, because some of these companies have had insane hedging losses as they hedged last year when the price was $40 a barrel. Now it's $80 a barrel. So that number is in our, if we go back to our email, we have Crescent Point Q3 financials is the full financials for the Q3. And this is a pretty big file. It has everything to do with the company. So I really try to avoid this file except for the hedging loss. So the number that you're looking for is your under commodity derivative gains or losses. You want to look at your realized gains. So what they're saying is that in addition to the 180 million of free cash flow that they generated, they lost $88 million because they hedged production lower than what the actual price was. So this 88.2 million is the number that we're going to put in our hedging impact for last quarter. Now, because it's a loss, it goes in as a negative. So the company lost $88 million in hedging last quarter. And to kind of go back to this and explain it just once again, is that if the company was totally unhedged and the company did not pay any dividends, we want to know how much free cash flow would the company have generated. And that's the number that we have in row 25 here. So it's your free cash flow plus your dividend and any impact that the hedging losses had on the free cash flow. So is that making sense, or should I go through that again? Does anyone need any clarification?
Yeah, that makes sense.
Hey, Shubham, quick question on the hedging impact. It could be a negative number when the prices are rising, but it would be a positive number when the prices are dropping, right?
Yes, that's correct. That's correct. Yeah. So for example, in 2020, a lot of this hedging impact would have been positive, which again, we want to take that out of the equation because it's a temporary thing, and hedging changes every month. The company could add more hedges. The company could close out their hedges. So we want to know, in a totally unhedged environment, in a totally the taking the price as it is, how much money does the business, the core business, generate before any financial additions or any acquisitions, etc. Is what it says. So yeah, you're right. When the price is rising, most likely the company will lose money on hedging. When the prices are dropping, most likely the company will gain on its hedging.
Okay, thanks.
Yeah. So what we figured out is that the Crescent Point has generated $286 million at third quarter pricing, but we don't know what the third quarter pricing was. What did the company get for its first oil and gas? And there's a question here about how much penalty would the company face for removing their hedges. Well, if they remove their hedges, they basically have to pay whatever money that they're in the loss currently in. So it's very, very rare that companies will actually close out their hedges. Most likely they'll just leave them and they'll take the loss as it comes instead of paying off the hedges and losing all the money right away. Just with the way the time value of money works. And so we want to know how much, what the pricing was at which Crescent Point generates $286 million of cash flow. So to get that number, we go back to our financials and we want to look at, this is on page 2, so it's right at the start. We look at benchmark pricing. And what Crescent Point is saying is that for all of quarter 3, the average price that they received was $70.55, which is under benchmark pricing, WTI crude oil, and for the 3 months ended September 30th. So 70.55. So we'll go back to our calculations. We'll put this number in. And this is always in US dollars. The rest of the calculation, everything else is in Canadian dollars. Because it is a Canadian company, but the pricing of oil is in US dollars. And we also want to know strip pricing. Strip pricing is the price that a company would get today if it locked in production for the next 12 months. So to give kind of a basic understanding of this is that the oil price that you see on Bloomberg or that you see on investing.com or TD or your apps is, what it's saying is that this is the price that the company can sell its production today or within the next couple months. This is the price. But if you want to sell production further into the future, the price might be lower, it might be higher, it might be the same. And where I get this information is, if we go, basically you want to go to the CME group, WTI pricing, and you want to look at the quotes. So I can send this link to whoever is looking for this after the fact. But basically what it tells you is, this is the pricing for the next, I think it shows pricing for like the next 20 years. So if you want to sell oil in December, you get $83.22. If you want to sell oil in next summer, May 2022, well, you're only getting 76 cents and $76.14. So what I do is I take the next 12 months, I add them up and I divide it by 12, which gives me the average pricing for the next 12 months. Does that make sense? How the strip pricing is calculated? And if there's any questions on that, just stop me anytime. So basically what I did is I added the next 12 numbers here for the next 12 months, what the oil price is, and I divided it by 12 to get the average price. And I already did this. You're welcome to follow along and do it on your own, but I got roughly 76.85. It might be a day or two behind, but that's roughly where I am on that.
Makes sense to me, Shubham. Thanks very much.
Right on. And then I've just left this box here, other annual free cash flow sources. So there's companies that you might feel, hey, Crescent Point is looking to sell this asset, and I think they can get some money for it. Or you think, hey, Crescent Point just bought out the Shell assets, and I think they can save 20% on OpEx on that, because it's they can save money, they can do some synergies. Cenovus is a big one because they say, hey, because we merged with Husky, we're going to save this much money by workforce optimizations, by doing a better marketing deals, etc. So you can put that in there. With Crescent Point, I personally don't see any free cash flow sources, so I'm just going to put 0 in there. You'll see in the next Cenovus example that there is free cash flow that I think there is put in there. And here we go. We have our calculations. So
Shubham, you might have to reshare your Excel sheet. We are seeing the two tracking.
Yeah, my bad on that. So here, column row 27 is where the strip pricing goes. Row 28 is your other annual free cash flow sources. And row 30 to 36 will be calculated on their own. So yeah, we'll just go through it and I'll kind of explain what these are. So row 30 is your annualized last quarter free cash flow. So Crescent Point, we're saying, made $286 million in Q3. And if we just assume that that's going to be the same share oil price, and they're going to generate the same free cash flow for all year, they're going to be at around $1.14 billion. And below that is our free cash flow yield. So the free cash flow yield says, with the money that the company is generating, how much of their enterprise value is a free cash flow generation. So Crescent Point's enterprise value is $5.7 billion. They generate $1140 million as a free cash flow. So basically, they generate 20% of the company in free cash flow. And why is that number important? Well, this 20% is exactly what you can expect to receive back. So if the company doesn't put any money into production growth, it doesn't put any money into acquisitions, you are looking at potentially getting 20% return in 1 year. So you could have a 10% dividend along with a 10% share buyback. You could have a 5% dividend and the company buying back 15% of the shares. It's kind of up to the company what they do with this money. And we're seeing companies saying, hey, half our free cash flow is going to go to dividends and half our free cash flow is going to go to debt reduction. So, some companies are more transparent than others. With Crescent Point, we don't really know if they have any plans to increase their dividend, but basically you're expecting a 20% return just from dividends and share buybacks, let alone the share price appreciation that you can get.
Shubham, is this a free cash flow to the firm or free cash flow to equity?
This is free cash flow to enterprise value. So to the whole company, including its debt and everything.
Got it, thanks.
Yeah, so free cash flow to equity would be just this free cash flow divided by your equity value, which is your market cap. So you can calculate that. I don't like to calculate to equity because some of these companies have huge debt loads that they have to service before they can pay dividends and do share buybacks. So I think taking the whole business as a whole is kind of a better way, and the way that I do things. And what I've decided, and I think it's kind of an industry standard, it's kind of been how companies have traded in the past, is that, you know, I'm not looking for 20% from a company like this. I'm looking for 12.5%. So I'm looking for a 6% dividend, and I'm looking for a 6% share buyback, or a 6% debt reduction. So at 12.5%, what I'm saying is I want the company to return the entire value of the company back to me in 8 years, because 12.5% per year for 8 years would be 100%. The math is not as simple as that, because share buybacks might affect your market cap and et cetera, but I don't really want to get into that. This is just a basic calculation. Paul is asking for the cells that are used in the equation. So this number, this annualized cash flow, is basically your, as you can see in the formula here, it's basically your quarterly cash flow multiplied by 4 to make it annualized. And then you add your additional free cash flow sources, which is 0 in this case. The free cash flow yield is your annualized free cash flow divided by your enterprise value, which is row 12. And that's yeah, so hopefully that explains it, and I'll kind of explain the calculations a little bit more as I go as well. I think that'll help for sure. And there's a different question here about share buyback versus debt repayment. How much of the difference for the share price? So this really depends on your personal, what do you want from the company? There are companies that are highly indebted that I would rather that they pay back their debt. There are companies where I would rather they buy back shares, especially, you know, like a company like Crescent Point that's trading at such a huge free cash flow yield. You might think, hey, you know, the debt can be paid off at any time, and the debt is at, you know, 2 to 3 to 5%. Whereas if they buy back shares, I'm getting a much bigger return. So there's no real answer to that question, specific answer as to which is better. It all depends on the company. In our most recent times, investors are looking for dividends and share buybacks. They're tired of companies that just keep paying back debt, and they never seem to end paying debt. So it doesn't affect the share price really in any major way. Like reducing your debt is good for the share price, and share buybacks are good for the share price. Again, there's a lot of subjectivity involved with that. So it all kind of depends on the company and how you feel about the company, what their goals are, what their debt situation is in. You know, for example, row 16 here, if their debt utilization is really high, I would hope that the company is paying back debt and not buying back shares or doing dividends, just so they have that little bit of a safety net in case prices do fall again. So yeah, so hopefully that explains it. And row 32 is just the pricing. So we have last quarter's pricing, which is 70.55. We have the strip pricing, which is 76.85, and then I just added four prices above that and 4 prices below that. You could do these calculations at whatever pricing you want. It's all the same formula. And when I'm saying that the company needs to return my money in 8 years, and I want a free cash flow yield of 12.5%, if you flip that and think of it a certain way, you're saying that in 8 years, the company must generate enough free cash flow to basically buy out the entire company, privatize the company, and pay back all its debt. So it's an 8 multiple that we use on the free cash flow. So in 1 year, the company generates 1143, and column row 34 is basically what does the company generate in 8 years to pay me back? And we get $9.1 billion. So this formula is just your annualized free cash flow multiplied by 8. So in 8 years, the company is going to generate $9,141 million. So $9.1 billion of free cash flow. But that's what it generates in 8 years. And in order to get the value of the company, we have to subtract our debt, because of that free cash flow, we have to pay back the debt before we can say, hey, what are the shares worth? So your valuation for equity just subtracts the debt. So our net debt here, which was $2.1 billion, is subtracted from the value of the company. So pretty simple calculation. And then all we do is we take the value of the shares of the company and we divide it by the number of shares. So we have 582 million shares. So at last quarter's pricing, I would want to see Cenovus worth 12.09 per share. And all the other columns are basically at different pricing regimes. So, you know, if you think, hey, over the next 12 months, oil is actually going to average $100 a barrel, well, the fair share price then is $27.71 at the multiple that I'm using and at the multiple that historically companies have used, at a multiple that I think is pretty standard for a lot of oil and gas companies in the past. And these are the numbers that we're getting. On the lower end of the spectrum, you can kind of see that $60 oil. At $60 oil, the fair price of a Cenovus share is $6.50, which is kind of where we are. So this tells me that in my mind, the market is valuing Cenovus or Crescent Point at roughly $60 oil still, while we sit at a $75 to $85 strip pricing regime. So it's basically as simple as that. Does that make sense to everyone? Are there any questions? Anything I can further add to? No, pretty good.
Hey, Shubham, a quick question. So we know Crescent Point is currently at whatever, $6,
Uh-huh.
and the fair pricing should be 12.
Uh-huh.
How do we know about the timeline over which the share price should grow to $12?
So there is no real timeline for that. Like we're using last quarter's pricing. So basically, based on the Q3 results that Crescent Point has put out, the share price should already be 12.09. Now, one thing I will point out is that it's not a end all be all number. This number is not a number where, you know, I value Crescent Point and I say, hey, it's worth $12, so I'm just going to buy Crescent Point and just leave it. More so, what the purpose of this spreadsheet and this exercise is that once you do a variety of companies, so let's say you're interested in 10 companies, you can run the same spreadsheet on 10 companies, and what this will tell you is which companies are most undervalued compared to their peers. And then those are the companies that I decide to do a deep dive on, and I try to talk to management. I try to get insights and kind of evaluate. So this number in itself is telling you what the share price would be valued at. Yes, that's correct. But the way that I use this number is to compare it to other companies. So, you know, what we're saying right now is that Crescent Point's share is about half of where it should be. You know, $6 versus $12. If we do, you know, when we do Cenovus and Hemisphere, you will see, and in the PowerPoint, I have a graph that shows the relative undervaluation at all these prices for the three different companies. And you will see why I choose to buy certain companies compared to other companies, because I see more potential in these companies.
Okay, thanks. So maybe just a follow-up question.
Mhm.
This particular modeling or the way the calculations has been done,
Yeah.
is it the standard practice by financial analyst, or is it your indigenously developed calculations?
I'm not going to say that it's an industry standard, but I will say that free cash flow times 8 is a pretty commonly used calculation. Some people like to use free cash flow times 6 when valuing small cap companies, and then they will use free cash flow times 10 when valuing large integrated big companies. So there's a lot of subjectivity to it. My reasoning for it is that, hey, if there's an oil company that can give me a 6% dividend and the same amount of cash going towards debt reduction or share buybacks, then I think the general retail investor or the institutional fund would be interested in this company. So that's where I come up with the 8 multiple and a 12.5% return on that. So these share price numbers are still kind of like what I'm looking at as my absolute value, but when I look at the overall scope of my calculations and comparing companies, it's a very powerful relative valuation tool. Yes, so it's definitely much more powerful for relative valuation, but it still gives you a general sense of what the share price roughly should be. And there's another question about the hedging losses. So you're absolutely correct that this share price, we've taken out the hedging losses, but Crescent Point is probably still going to generate the same hedging losses for the next at least 3 months, if not 6 months to 1 year. So, you might think, hey, this valuation is a little bit over. It's quite liberal in what it's trying to say, is that, hey, like, let's assume the company has no hedges, when in reality it does. So these sorts of calculations are more built for the long term, where we can assume that, hey, a year or 2 or 3 or 5 into the future, the company is not going to be stuck in these huge hedging losses that they would be in this case. But if you're looking to if you're looking to buy the company only for short term, we have an optional hedging scenario here. So when we look at row 39 all the way to 58, you can put in, hey, in Q4 the company has this many barrels hedged at this price, and then for the next whole year you can do that, and this spreadsheet will calculate this for you. So if we go into the Crescent Point numbers that I've actually done, I looked at the hedging of Crescent Point. So we'll go back to their corporate presentation, and we see they tell you all the hedging that they've done for the next, all the way up till the end of 2022 in slide 12. So I took this information and I put it into the seminar calcs as, okay, in Q4, Crescent Point has 40,000 barrels hedged at this price, Canadian dollars. And this is Q1 of 2022, this is Q2 and Q3. And we get our hedging impact based on all these pricing regimes. And what we see is that the company is still worth $10.42 if you include the next years of hedging losses. And all of this is the exact same calculation. The only thing we've changed is we've said, okay, how much money is the company going to lose in the next year on hedging? So this is kind of an optional thing. Once I do these base calculations for a bunch of companies, I'll go in there and say, hey, these are the companies that I'm interested in, and these are the companies I'm gonna do the hedging calculation on. I'm gonna try and talk to management. I'm gonna look at new drills. I'm gonna look at capital expenditures, and just go from there. You know, we can complicate this as much as you want. But hopefully that explains that part of it, Vincent, based on your chat. And in terms of people are wondering, like, okay, like what's the company valued at right now? What kind of multiple does it have? So you know, you can run once you have the spreadsheet, you can run your own multiples. So if you think that you want a 20% return on these companies, so you're only going to use a 5x multiple, then you know, all you do is you change you change your formula to be 5, and you know, so right now the company is exactly being valued on a 5 multiple, because once we changed our multiple to 5 right there, our fair share price became 621. So the market, 20% return from this company right now, but you know, that's extremely competitive when you look at the rest of the industries out there, the banks, etc. You know, there's not that many companies that people really want a 20% return from. So as people start to see this, I think that the valuation on an absolute basis will start to get better, the gap, and then there are certain companies you will see on a relative basis have even more potential with them. So I hope that kind of answers some of the questions.
So quick question on the multiples. So
Yep.
one of the things is based on the fears of larger investors coming back, what I'm seeing some of the people use in their presentation is about 4 to 6 times multiple, between 4 to 6. Is that, do you feel like that's too conservative, or like what are your thoughts on that?
So the 4 to 6 multiple that you see being mentioned, and that's on presentations, what they're using is a 4 to 6 multiple on adjusted funds flow. So that would be your 394 million instead of the 8 times free cash flow. So it's 2 different ways of doing things. The reason I like free cash flow is because at the end of the day, that's the money that's going to be used for dividends and share buybacks and debt reduction. Your adjusted funds flow could be really high, and then you're pumping it all back into the company in interest expenses and new drills and doing capital expenditures. You're doing new compressor stations, etc. So you know, it's just too hard. It's not stable enough on a quarter to quarter basis, because some companies spend more money in Q3 and Q4 as the winter drilling comes on. So I like free cash flow because that's the money that's going to come back to me in one way or the other. So I use free cash flow times 8. You can use adjusted funds flow times 4, adjusted funds flow times 6. You know, but for the retail investor, I think free cash flow is better, because you don't really need to know anything about the company. All you need to know is how much money is the company generating and how much money is going to come back to me. So that's my reasoning on that. Yeah, so that's basically the what I use to value these companies.
So another good question, free cash flow times 8, it means that if this company wanted to privatize, they could privatize in 8 years?
In 8 years, yeah, that's correct. They could, like, we know that's not the case, because as you start buying back shares, the share price increases, etc. But yes, on a very basic level, what I'm trying to say is that this company, I want a 12.5% return so that the company can privatize in 8 years if it wanted. But that's not really what I want, because I want dividends. I want some sort of cash back to me, not the company trying to cannibalize itself. But yeah, from a strictly financial standpoint, that's what I'm saying. Is that I want the company to privatize within 8 years, and I think that's pretty conservative, given where we see oil demand and people really starting to understand how important oil is to our way of living. You know, that's compared to some of the graphs that Eric Nuttall has put out, you know, where companies can privatize in 3 to 4 years. I think eight might seem a little liberal, but it's still a very conservative compared to the valuations you're seeing out of companies like ExxonMobil and Chevron and some of the big players. The bigger companies like Shell, I think eight is a very good multiple to use.
Although Sohail and Shubham, I think the privatization is more of a symbolic aspect, I would think. It is more of the 12.5% return, which is more meaningful parameter here, isn't it?
Yeah, it's more of a symbolic way just to represent it and so people can kind of understand. Yes, certainly. And then there's a question about natural gas and the refining business. My calculations are built for upstream E&Ps and some integrated companies, and mostly oil plays. I do have a similar spreadsheet I can use for gas plays. I don't see the same potential in gas companies. I don't see the same free cash flow yields. So I have generally avoided these companies in the recent past. But if that is something you would like, I can send you the spreadsheet that's built for a gas play as well. In terms of refining business, the refining business doesn't really affect the company that much, just because refining margins don't change that much from quarter to quarter, and how much money the refining business generates is strictly based on the WTI pricing for the most part on these integrated companies like Cenovus and Suncor, because they're selling their own oil to their own refineries. I don't have any way to value strictly refining companies. So if you're looking at companies like Valero and such in America, I don't have any way. I don't go into that industry, so I don't have any insight to offer. This is mostly for upstream E&Ps only. And there's a comment here about the free cash flow yield, and you're absolutely right. At today's share price and the free cash flow yield that the company generates, it is 5 years. Yeah, you're correct. What I'm saying is, I don't need it to be in 5 years. I'm happy if it's within 8 years, and that's why we see this difference in the free cash flow pricing, the fair share price. Because I'm not looking. I don't think any company should be expected to be able to privatize in 5 years. It's just not reasonable. So I'm looking for 8, and at that 8 multiple, this is the share price that I get. Yeah, so that kind of concludes the Crescent Point part of things. If there's any questions, I can take them now, or we'll move on to Cenovus next.
Shubham, not a question for you, but for the other participants, since some of them mentioned that they do similar kind of technical analysis. So wondering if it is in sync with the kind of analysis which they do, if anybody wants to comment.
Yeah, certainly. Like if anyone else has any other methods, or they've worked at places in the past, they've used different multiples. I mean, I'm always happy to have a discussion as to what the multiple should be, and meaningful conversation around that. It does get a little complicated, given that this course is built for like the basic investor who's not interested in doing finding their own ways or doing deep dive into companies. But if there are people who do run similar calculations, by all means, you feel free to mention them now, or if you want to have a discussion about some of these things, I am always open to that. My email and phone numbers are in the presentation, so yeah, certainly. So one of the questions we we have now is what multiple would you sell the stock at? You know, what multiple would it be overvalued at? Well, you know, our fair share price is $12.09. If I see the price going higher than this, that's when the subjectivity part of it really comes in. For example, a company like Cenovus or Suncor or CNRL, you know, people may not be looking for a 12.5% yield on it. So especially the bigger banks and institutions, they might be looking for, you know, they might be happy with a lower yield. So if you think the company is going above that valuation for certain reasons and you still want to hold it, yeah, certainly. But for me, the way I do these things, if I see a company trading at more than 8 times free cash flow, my thinking is not, hey, can I make more money in this company, or is it undervalued or overvalued? My thinking is, hey, this company is already trading at an 8 multiple. I can find other companies that are trading at 3 or 4 or 5. So my risk reward is much better in those companies. As long as they have the same risk profile, why would I not put my money into a company that's trading at a lower multiple? So, so when the share price does go over this, I don't really do a lot of research on that. I just kind of let that company do its thing, and I move into other names. Yeah, that makes sense. It's a matter of relative valuation once again. So, you know, if there's a company that's run up a lot and they're trading at an overvaluation, unless there is some really distinct reason for that, I would be looking to move my money elsewhere once it reaches that. And also keep in mind, like, Crescent Point price might hit $12 in 6 months, let's say, but if the price of oil is $100 by then, well, now the fair value of share price has moved up significantly. So you always want to keep an eye out on your fair share price compared to what the WTI pricing is, compared to your relative valuation to other companies. Yeah, so I think that's good on that end. We can move into Cenovus. So sure. So we'll go back. We'll open our Cenovus supplemental. We'll open our Cenovus September presentation. And yeah, so if everyone has those files open, we can get started on Cenovus. We run the exact same spreadsheet. We run the exact same calculation. It's built. This spreadsheet is basically the initial work that I do when I come upon a new name or a company releases their Q3. I'll go in, I'll pump all these numbers in, and I'll kind of show you what I do at the end once I have a couple of them and how I compare them. But yeah, we can get started here on Cenovus. So we're looking for the exact same numbers. So our 2021 production is around 770 million or 1,000 BOEs per day. So we'll put that in. The liquids percentage is not in any of the files I sent you. It's in the Q3 full financials, like the one we looked at for Crescent Point. It's available on the Cenovus website. And I can kind of go through that if someone wants, I can find that file and show you the number. But basically, what you're looking for is the percentage of liquids in the company, which I know for Cenovus is roughly 80%, because of their heavy oil sands operations. That's roughly what it is. The number of shares outstanding, what I usually use for the number of shares outstanding is, if the company doesn't have it, I will go to any of your banks, whatever you trade with, they will all have this information. I hope everyone on the call is familiar with that. If you're not, I can run through Cenovus in a little bit more detail next time as well. But from my knowledge and from TD Bank's latest information, I know Cenovus has roughly 2 billion shares outstanding. The share price closed at $14.80 on Friday, and we can then go to our presentation, and we see that now Cenovus has not released their Q3 yet, so we're still waiting for September 30th numbers. For the sake of ease, we'll use June 30th numbers for now, and we'll give you an idea of what to expect at results time, which are this Wednesday, I believe. So net debt right here on page 14 is $12.4 billion. So we'll go in here, we'll put 12.4 billion. We'll put $12.4 billion into our current debt, and we got our market cap, we got our enterprise value, and we get our debt to EV ratio. So now that I have this, I would go back to Crescent Point and say, hey, Crescent Point's debt to EV was 0.37 and Cenovus is 0.3. So Cenovus is in marginally a better place in terms of its debt management currently. So, whether that plays into your final decision on whether you want to buy the company or not, well, that's where a little bit of the subjectivity comes in. Debt capacity is not important, so we'll leave it for now. Stay flat capital, you can put it in. A lot of this information, you really need to go into the Q3 financials to get. These two boxes especially are what I call optional boxes. They don't affect the calculation. Cenovus's annual dividend, which again you can get from the corporate presentation or from your bank, is 7 cents a share. And again, these are the two numbers we need. So we'll go back to our presentation. Right at the top, we have page 4. We have adjusted funds flow and we have free funds flow. So 1817 and 1283. So we'll go back to our Excel. 1817 and 1283. Does that make sense to everyone so far? I'm kind of going through faster on this one. If there's any questions, feel free to put in the chat or interrupt me anytime. Cenovus as a company, because they have a upstream business and a refining business, they don't really hedge their oil because they're selling their own oil to their own refineries. So hedging doesn't really affect them that much. Cenovus still has a few hedges, but they don't make a meaningful enough change. So I'm just going to put 0 on the hedging. The last quarter pricing, we go to our we need to go to the Q1 supplemental information that was given in the email, and we have same thing. We're looking for the exact same thing. A lot of these financial statements are standardized, so what you see from one of them is exactly what you're going to see from the other one. So we see here that West Texas Intermediate was at 66.07. This is on page 3. So we put 66.07. Our strip pricing again was calculated using the CME group data on the internet, was 76.85. So when we look at this, we're seeing like, hey, based on the last quarter pricing, our share price is actually pretty close to what the valuation is of the company. Like we're just about bang on, you know, but we say, okay, well, so the company is already fairly valued. So why are we even bothering with this company? And that's when you really need to do a little bit of a deeper dive into the company, which is that in the Crescent Point example, we used Q3 pricing, which is much higher than the Q2 pricing we're using for Cenovus. So at strip pricing, we see a fair share price of $24.58. So, you know, it doesn't quite have the potential that Crescent Point does, but it's close. And then once you really understand Cenovus, we can go back to our corporate presentation, and what we see is that Cenovus is kind of a different beast. They bought Husky last year, and they're saying, hey, in 2022, we're going to generate an extra $1.2 billion of annual run rate savings, and they've already realized almost $1 billion of that. So, you know, you start thinking, hey, so they've already saved $1 billion. Some of that would have been in Q2, some of that would have been in Q3. You know, 2022 onwards, they're saying 1.2 billion. So let's take half of that. Let's say the company is going to have an extra $600 million in extra free cash flow. So we'll put that in there. In addition to that, if you look at your global supply demand and American supply demand, we see that line 3 is now online, Enbridge line 3. We see that the Capline pipeline has reversed, and we have now an opportunity for Canadian oil to get from Cushing and Patoka, Illinois, all the way to the Gulf Coast for export. So, you know, you can say, hey, the company is going to be generating an extra, well, we'll go back to the presentation. So what the company is saying is that for every $1 change in the WTI to WCS differential, they make an extra $150 million. So if you think, hey, because of these 2 pipelines coming on and because of more demand for crude, the differential is going to shrink from $14 to $10. So that's $4 a change times $150 million per dollar of change. So another $600 million of potential free cash flow that you see in there. So now we go back to our seminar and we add another 600 to this 600, so we get 1,200. You might say, hey, Cenovus has a lot of non-core assets that they're looking to sell. They got 200 million from Headwater sale. They might get another, you know, X amount of money from the Deep Basin asset. They might get X, Y, and Z. So, you know, me personally, I think they can get at least $300 to $500 million in asset sales next year, non-core assets. So I add that in there, and that's when the valuation really starts looking good. You know, at strip. Yeah.
So if they sell these non-core assets, won't that affect their production as well, and as a result affect their cash flow generation? Or you think these assets are really minimal? They can easily make up for this loss of production through the main assets?
Yes, so that's what I'm saying is that they can sell these non-core assets. They might lose production, but what they're also losing is a lot of the asset retirement obligations, um, a lot of the high operating cost assets, because it's non-core to them. They don't focus on optimizing them. They don't focus on really developing them. So these assets are the highest operating cost assets. They're the least revenue generating assets. So if they sell them, yeah, they're going to lose production. They're going to lose a little bit of their adjusted funds flow, but I don't think they lose too much of their free cash flow into that. So again, a little bit of subjectivity in there. I
No,
know
I totally agree with you.
Yeah.
I think what you're saying is really right. Yeah, it's the lowest net back barrels that they're basically using.
Exactly. Yeah, and then
got
they
it.
have more time to focus on their main assets. They might be able to lower operating costs a little bit more. Better use of manpower and employees and contractors, etc. So, what we end up with is that Cenovus on strip pricing is a double from here. And where it really starts to get interesting is if you believe that oil pricing is going to go higher to the $90 to $100 barrel range, we see a 4x, a 3 to 4x at $100 oil, and if price stays as it is, we still get a 2x. So there's incredible free cash flow generation potential on a company that people would say is one of the most stable companies. It's one of the most well-managed companies. It's almost a blue chip, you can say now, after its merger with Husky, and their production is rivaling CNRL and Suncor just about. So, this, I like to show Cenovus because people say, yeah, these oil companies are very high risk, so I don't want to get involved. But you have blue chip, really good companies, really stable cash flow generating companies still trading at half of what they should be. So, whenever there's a new investor, someone who's looking to be a very safe, looking for a very safe bet, I always recommend Cenovus, because even though it doesn't have the cash flow potential as some of the other companies, it's the stable, dividend paying, low growth name that people are looking for. Great management. A lot of the subjectivity points are really hit on this name. And yeah, there's a comment here that they had a incident at their Superior refinery which destroyed that. So they're spending a bunch of money on rebuilding that. So you can add another 200 million of free cash flow there. And the other thing to realize is that this net debt number is old. It's a June 30th number. So if we're looking for a number today, you can just come here and you can say, hey, the company generates roughly $7 billion a year, so they can reduce net debt by a quarter of that, so 1,800 million, and you can take that out of your net debt, and that adjusts the numbers. So the base spreadsheet is very simple. And then once you want to get into a little bit more of these discussions and subjectivity matters, that's when you can really nail down, like, okay, this is why this company is not getting the respect it deserves, because most people just do the base calculation and they're saying, hey, I can buy X, Y, and Z company, which has better potential. But when these institutional funds and the fund managers and banks start to get into these companies, they see these things. They see these other free cash flow sources, and they will be buying these companies that have hidden potential in them or are being discounted by the average investor who doesn't really want to get into this level of detail. And yeah, Cenovus has no hedging, so has very little hedging, so I didn't even bother with this this side of the equation. Yeah, Is there any other questions on Cenovus? Anything else to add? Anyone has any comments or?
I just guess since we've been going for about 2 hours here, like, do you think there will be enough time to just briefly touch on, surge energy?
Yeah, so I'm totally open. Whoever wants to stay after this point is welcome to stay. I have a very quick calculation on Hemisphere because I know there was a couple people wanted to know about that. It's kind of a new company on my name, and I'll show you why the relative valuations are important. For everyone else who is kind of happy with this for now, I really appreciate you coming in and taking part in this and contributing. This entire video will be posted on our website. So if you want, you can kind of have a look at it later. But if you want to continue with Hemisphere and then onto any other company that you want to look at, I'm available. I'm here. I really want, I want to see how this goes. I want to get some good feedback. So if you have any feedback as well, feel free to email me, call me, message me, either or. But yeah, for whoever is staying, we'll continue on to Hemisphere and then do Surge and then kind of continue on. And then whoever is I guess happy so far. Thank you so much, and I look forward to your feedback and looking forward to you at the next one as well.
Yeah, thank you so much for putting this together, man. The stamina on you. We're all collectively, I think I can say on behalf of everyone else, we're really grateful for sticking with us and really, going in and doing the deep dive. Thanks very much.
Well, you betcha. And
I just stole the words from my mouth. I was going to say the same thing. So.
No, I'm really happy. It's great to see support. It's great to see passion for the industry. I'm really happy to meet like-minded people. It's been kind of a rough 6 or 7 years. A lot of people, a lot of naysayers. So it's good to see some passion and excitement again. So let's continue on to Hemisphere. Okay, so I believe for Hemisphere, I only sent the corporate presentation out, which actually is extremely updated, and it has a lot of the information we're looking for anyway. So we'll keep it simple. So this is a new name that kind of came up on my radar. I always had this name on my mind because it's one of those smaller cap names that people don't look at, but the management is very involved in the company, and they're not here to become a huge company. They're here to generate free cash flow, return it to their core group of management, their core group of high net worth retail investors, and their core group of funds. So we'll get right into it. Share. So Hemisphere. We look at the production. We're at 1786 a day at 99% heavy oil. It says in small lettering just next to it. So we'll put these numbers in: 1786 and 99. And so we'll go back to this. Basically, sometimes you want to use the fully diluted shares outstanding if there is a significant difference in the basic shares and the fully diluted shares. Here it is significant, but it's not significant enough that it affects the calculations. So I'm just going to use the basic shares. So 90.5 million is what I'm going to put in there. So we'll go back here. So 90.5. The share price, I believe, closed at 90 cents on Friday. So we got 81 million of our market cap. We go back here, our enterprise value is 98.5 and our debt, or our market cap is 80. So that tells us that the net debt is $18.5 million, because that's the difference between the two. So we'll go back to our spreadsheet and we'll put 18.5 in here. Debt capacity, again, not too important. These are numbers that I would put in later on once I find the potential of the company. The annual dividend, Hemisphere does not have a dividend. And this company is a company that I'm going to value a little bit differently because it's a completely different play. So what's nice about Hemisphere is that they tell you what they're doing in 2022 on page 11 of the corporate presentation. So on the top of this page, you can see it says US $60 a barrel WTI. So all these numbers are at $60 a barrel. And we see that this is a growth play. The company is growing its production by roughly 35% next year. So any company that's not a stay flat company, you have to value it a little bit differently, because the increased production will change your free cash flow and your capital expenditures significantly enough. So I'm going to value this company on a 2022 basis. So what they're saying is that in 2022, we're going to generate $30 million of adjusted funds flow at $60 oil. So $30 million a year is 7.5 per quarter. So I'm gonna go back to this. I'm gonna put 7.5 under my adjusted funds flow. And in terms of our free cash flow, it says it's going to be 23 million. So again, 23 million divided by 4, so we get 5.75 on that. So on your free cash flow, we'll put 5.8. And that's at $60 pricing. Our strip still sits at 76.85. Other free cash flow sources, I don't see any big sources for this company. So I'm just gonna put 0 in there. I'm just gonna go back here for a sec. Yeah. Now, because we are using 2022 numbers on our adjusted funds flow and free cash flow, we need to go back and adjust our production to 2022 numbers as well. So our average production is 2550 BOEs, which is again, it's all in the corporate presentation, which is every time I have a meeting with the management, that's what I try to tell them, is we need all this information in the presentation so that we can go through things a little easier. So so if we go, so 2022 production is 2550. So we'll go back to our Excel and we'll just adjust this to 2550. 2550. And basically the rest of the calculation is here for you. So this is the number that I'm looking at. So we look at our free cash flow yield at strip. At strip pricing, this company is almost at a 40%. It's almost at a 40% free cash flow yield. So we're trading at roughly double what Crescent Point and Cenovus has given us. And at strip pricing, our fair share value is $3.22. So there's a lot more potential in this company. And there's a lot more risk, as people would assume that, okay, well, it's a smaller company, so we have a lot more risk involved in this company, so the potential should be higher. But if we go back to our calculations, we see a extremely strong debt to EV ratio. This company has barely any debt, and this is at the end of Q2. So based on my calculations, this company can be debt free within the next 5 to 6 months. So where is the risk? There really is no risk in this company. It's almost less risk than Cenovus and Crescent Point, because its debt profile is a lot better. They're also growing production by 35% compared to Cenovus and Crescent Point keeping their production the same. And in addition to that, their free cash flow yields are double what we're getting from the other companies. So once I see this, I start to think, okay, can I do a deep dive on this company? Can I see what's really going on? Like, how are they able to grow production so much and still generate these huge gobs of free cash flow? So I had a meeting with Don Simmons there. I think I posted that on LinkedIn, and kind of just went through a bunch of things. And that's when we come up to one of the unique things about this company, which is that this company is not a brand new well driller. This company, what they do is they have a lot of assets of previously drilled vertical wells and excellent delineation. And what they're doing right now is they're implementing a water flood and a polymer flood in these pools, which are enhanced oil recovery techniques and can increase recovery of old abandoned fields. And they're getting huge production from these polymer floods, and they're spending very little money, because all they're doing is converting producing wells to injecting wells and injecting a little bit of polymer and waiting for the response. So this is a company where there's a lot of subjectivity, and you can really convolute things and look at it that way. But basically what I'm trying to get at is that once you do these companies and you look at the relative valuations, that's when you go into the deep dive and try and figure out, okay, what exactly is going on? Are there anything that we've missed? Is there any non-core assets that they own? And, I came up to a company like this, and, I'm thinking, hey, why don't I put all my eggs into this basket and just let it grow? But, that's, again, back to subjectivity. This company is probably never going to pay a dividend. Just the way they're set up, they would rather just kind of, you're looking for a company that's going to privatize, and you really want that. Well, this might be your play. You're looking for a company with dividends and low growth. Well, Cenovus might be your play. And once I do all this, I go back to my PowerPoint, and I generate a table. So the table will say, what's our current share price? What's our Q3 or our last quarter pricing? What's our share value should be at strip? What our share value should be at all these pricings? And we convert them to potential gains. So from the current strip price, what sort of share appreciation are we getting compared to the current share price? So, if you think that oil price is going to be a little bit lower, maybe there's better plays. But as the oil price goes higher and higher, which is where I see things going, we see that the relative valuation is not that much difference, and you get a lot more stability and a lot more eyes on names like Cenovus and Crescent Point. So, if you think oil is going to $110 a barrel for the next 12 months, maybe Crescent Point or Cenovus are worth having the extra institutional interest and the extra retail eyes on the stock to give up the little bit of gains. But if you're saying, hey, I just want to buy one company and I want to go for the Hail Mary, I want to go big or go home play, well, you know, maybe you want to look at some of these small cap names, the PDF file. So yeah, can you see the PDF now better?
What we see the PowerPoint is what we see.
Okay, yeah, so this is a PowerPoint. The PDF was sent in the email, so you can have a look at that. Or if we go, yeah, this is the corporate presentation PDF. I'm happy to go through this one if someone wants a little more information as to why I did things a little bit differently and the subjectivity that comes into it. But on a core understanding standpoint, the point that I wanted to get across with this third one is that on a basic valuation, this company doesn't look very good. But once you realize that they're also doing a 35% production increase and that their net debt is almost zero, you know, maybe it's a play you're more interested in. So the spreadsheet is just a start. It gives you the basic knowledge that you need. And you know, people say like, oh, well, once I have that, I can just start valuing companies and buying stuff. And yeah, that is true. You can do that. But if you're investing significant amounts of capital, you really want to do a little bit of a deeper dive into these companies, get to know these things, some of the more advanced techniques to really nail down exactly what the company is worth. If we go back to the seminar calculations, what I've done here is I've also put in the impact of the hedging. So for Hemisphere, they've hedged 800 barrels at roughly $70 Canadian. And I find that information, I don't know if the PowerPoint has it. Yeah, right here. So page 23, you see exactly every single hedge that the company has. So, you know, you take this information, you pop it in here, that next quarter they have 800 barrels hedged at $70 and X, Y, and Z, and our yields change by a bit. It's nothing spectacular, but you know, what I really see with this company is hey, if you believe in $110 oil or $120 oil, you know, the option, I had somebody message me about a couple of weeks ago and said, hey, you know, I don't want to buy Cenovus. I'm not interested in any of this. All I want is a Hail Mary, you know, ball out of the park play, and I'm willing to lose it all. And I said, hey, you don't even have to lose it all. Here's a company that is a call option on oil, and you still maintain that it's not going to go bankrupt because there really is no debt. So your individual circumstances will affect a lot of your decisions, but using these spreadsheets and techniques can really help you generate an absolute value to look for and a relative value as well to look for.
But this gentleman, he can get stopped out if the company decides that they're not going to pay a dividend and that they're just going to privatize.
Mm-hmm.
Then, you know, they're just going to give him his money back, and he won't be able to, you know, he'll end up getting locked out of the trade.
Yes, that's correct. But the company will never be able to buy back shares at its current valuation. Like it might be able to buy back 10% or even less, but it's basically going to have to jack up the share price to keep buying back shares and privatize. And you know, that's why I really like to meet with management, and I ask them like, hey, if you made an offer tomorrow to buy back all your shares at X, Y, and Z valuation, how many of your investors currently do you think would go for that? And I don't want to sound like I'm trying to sell Hemisphere here. It's just a company that I bought a position in, and it's a pretty small position relatively. But there are plays out there like this, and in terms of getting stopped out, it is a possibility. Maybe come into next year, the company might implement a dividend. They might say, hey, we're generating more than 50% of our enterprise value in free cash flow. So let's pay a special dividend. Let's pay 40 cents a share, or whatever it is. So you leave that option open, and this is a low risk, high reward play that could come to fruition, that we're invested in as of 2 weeks ago. Well, there's a question here. It's a micro cap. Will institution ever buy shares? And your answer is probably no. Institutional interest will probably never be into here, and it will never receive a fair valuation on an FCF to 8 multiple. And that's where, like my conversations with management has been that, hey, if the market is not willing to give us the valuation we want, we'll buy back our shares. We'll just keep buying until it gets there, and we'll keep reducing our net debt. We'll become a debt-free company, and then, based on, if you kind of extrapolate that to me sounds like they don't want to pay a monthly dividend, but they might come out with a special dividend or other ways to return cash, because there's no use of keeping cash in a company that's debt-free and is not doing anything with it. So yeah, that's kind of my comments on that. I know there's something on the chat here about comparing it to Clear Energy, which is another one, is another play that I really looked at in detail. But I would almost say that I know there's a comment here on that. If you're interested in Gear, I would suggest that you should run your own calculations on Gear, and you will be surprised as to how overvalued that company is. So that's all I'll put there. I guess I'll leave it open on Gear, because I don't have the latest information on them. But if you want to run the calculations yourself and kind of give me a fair share price that you came up with, I know that the share price that I came up with the last time I did this spreadsheet on Gear, and to me, I was seeing almost no potential in that company. It's pretty fairly valued due to their incredible management team and some of the people involved in the company, and their execution, their operational execution is probably top decile in the industry. So it's already receiving a lot of praise. So it's not a company that I'm really interested in due to that. But yeah, if you run the same calculations on Gear on this spreadsheet and you come up with a number, I'm more than happy to have a call and discuss directly, or maybe discuss at the next seminar, the next test run of the seminar.
Have you by any chance gotten a chance to look at Razor Energy?
No, Razor's another one that I haven't really been interested in the past due to, I believe, their high net debt position. But once again, same thing. If you're interested in any of these names and you run these calculations, I maintain spreadsheets. I don't really update them if I'm not actively interested in the company. But if someone on this call is running the same numbers on a different company, I'm more than happy to go and update my spreadsheets and have a discussion. There are companies that will surprise you both ways, from an undervaluation and an overvaluation standpoint. And there's a comment here about checking inventory, and that's something that's really quite important, because inventory basically means is that how many more years can the company continue at the same production level without having to buy more land or buy more acreage or buy more drilling locations. And it's something that I used to really focus on, but what I've realized over the years is that the majority of companies, I would say 80 to 90% of companies, their inventories are within 10 to 15 years. So I wasn't really gaining any insight. The only difference is oil sands companies. So Meg Energy, Cenovus, CNRL to a point, and Suncor all maintain inventories that are like 30 to 50 years. So that is something to take into account, but I also think that my investment mandate is for within the next 3 to 5 years as a max holding period. So, you know, whether the company has enough reserves for 15 years versus 30 years, it doesn't really affect my calculation too much. You know, we can compare companies on all kinds of things. You can look at decline rates, you can look at reserves, you can look at your net asset values, etc. And you know, if anyone here is actually doing that on companies and wants to have a discussion, that would be great. But as far as my own calculations, when I'm looking at 20 to 30 companies, I just don't have time to look at these minor things that affect the price. There's a question here on my exit strategy on HME, which is Hemisphere. I don't really have an exit strategy right now. I'm looking at a 3x play currently, just because of the share price undervaluation and kind of where I can see that investors could move into this space if it's properly, you know, put out there and there's eyes on the name. But this is really, I don't have a way to buy call options on WTI pricing, and I'm kind of using Hemisphere as my cheap call option on oil. So if oil continues to go up, this is my big reward play. And yeah, I'm really happy that Hemisphere's investor relations team is basically top notch. You can call them anytime and kind of figure out like, hey, what's the latest update? How's production looking? What's the plan for the free cash flow? So I think until I see their strategy change or anything happen, I'm just gonna hold on. And if there's talk about a dividend at some point, then I think I could see myself invested in this for the long term, especially if you can get in at a pretty decent valuation.
At this point, Shubham, do you think there might be some time left for a sparky conversation?
Yeah, certainly. We could certainly look at Surge Energy. Was anyone else here on the syndicate as well, besides myself and Sohaib, the Surge syndicate? No.
I don't think anyone else got a chance to.
Oh, that's all right. So, so Surge Energy is a very, again, it's kind of a different play because they've just done a bunch of acquisitions. They've just done the share consolidation. So a lot of the information is a little bit hard to find, and you're having to make deductions on what they're going to be doing next year. However, I have a, just give me a moment here. I'm going to open up the latest corporate presentation.
So just a little more qualitative, Shubham, before we get into the nitty-gritty details.
Okay. Yep.
So for this, like, would you be able to speak a little on to the quality of the assets that they have? So in terms of when we look at them and maybe some of the other companies that haven't run up as much, when we look at them compared to maybe Whitecap, that, their, value prop is all the stuff that they're doing in regards to carbon sequestration. When we look at, Crescent Point and the assets that they've got, I don't know much about what they're doing, but, when we compare them to these other companies, what would you say distinguishes Surge from all the other ones out there that, they currently got going on for them that no one else, competes on?
So as far as the qualitative portion of that, I'll begin with kind of the point we were discussing before the meeting here, which is that for the last 3 to 4 months, if not longer, Surge has been stuck in this deal period where they made a deal with Astra, and that took a while to close. Then they had the share consolidation, and then they had the deal with FireSky, which is closing on Monday, followed by their Q3 results on Wednesday. What tends to happen when a company makes a deal, and you can go back and kind of check this, no matter what the company is, whether it's Surge, whether it's Whitecap, whether it's Cenovus, the company ends up getting stuck in this range when they make a deal with their shares. So when they use equity and they dilute the shareholders to buy another company or merge with another asset, there's a lot of market people at play who, what they will do is, if the deal price is at $5, as soon as it goes, 2% below $5, they'll start buying shares, and then they'll sell them as soon as it goes a couple percent above $5. So there's too many short-term market participants to really get the proper share price valuation. And compared to 3 to 4 months ago, when they made the Astra deal, oil prices are up $15, $20 from then. Meanwhile, the share price has been stuck in this rut. So from an undervaluation standpoint, Surge, that's the reason why it's my biggest holding, is because as soon as it gets out of this period, I feel like the market will recognize its value, and these short-term participants will no longer be interested. So we'll get to the actual quality long-term holders or people who understand the company a little bit better. Coming back to the asset quality. So the way a lot of companies are valuing their wells right now is based on a payback period. So they say that, hey, we can drill this well and we can get all our money back within 8 months or 6 months or whatever it is. So you look at companies like Crescent Point, for example, they say their rates of return. We got Whitecap, you mentioned, and the problem with this way of evaluating wells is that we all know that unconventional wells have some of the highest decline rates we have ever seen. Some of these wells are declining at 80% in their first year. So, the well might pay back in 8 months, but then it stops. It basically doesn't generate any more cash flow. It's a huge decline on it. And a lot of companies are touting that as saying like, hey, we can drill these wells and make all our money back, and then the rest is total profit. Well, that total profit chunk is actually very little. So when we come back to Surge, a lot of Surge's production is a lower decline. It's more of a conventional play, a lot of water floods, a lot of heavier oils, and their payout period is not 6 months or 8 months. It might be a little bit longer, but the wells don't decline as fast. So you're still getting really good production from these legacy wells. And the most recent chart that I've seen is very interesting. It shows how in what time frame the wells pay back 2 times. So not just once, you got to pay the well back twice. And what you end up finding is a lot of these unconventional plays that were at the top of the list for paybacks are now nowhere to be seen. So because the well has declined so much that it basically takes so long for it to pay out a second time. And Surge has, according to the information, has 2 of the top 6 plays which pay out the fastest in two, which pay out 2 times the fastest. So what you're getting is you're not getting the peak production and the huge numbers that other companies are throwing out, but what you get is a very stable, a very predictable cash flow generation model, a very predictable production profile. You get a very good cash flow that's reliable. You don't need to spend huge amounts of money to maintain your production. You know, like it's not that you don't spend any money. You still spend a lot of money to keep production flat, but it's not to the same extent as some of these condensate plays or Montney pipestone plays, etc., that are jamming so much capital into going past their treadmill of production decline. That you know, when the oil price goes lower, there's a huge risk to these companies, and when the oil price goes higher, well, they need to start jamming out wells and really maintain that production and get that huge cash flow right at the start. Whereas companies like Surge, I think, have downside protection where, you know, they don't have these huge changes in production, and they also have upside participation because a lot of their barrels are heavy barrels, which you know, if WTI goes up 20%, well, WCS goes up 30% just because the way their pricing is, one's lower than the other. So there's a lot of benefits I see, and for the way that White Tundra operates, we have roughly 50 to 60% of our portfolio into one major equity. So, you know, I'm really interested in names like this where I have downside protection, I have upside participation, and I have a very reliable cash flow profile. And if I can get that stock at an extreme undervaluation due to you know, a summer of deals, then yeah, then, you know, I'm gonna have my base portfolio into companies like this. And that's kind of my thoughts on Surge from quality standpoint. There's a question here on how does Surge compare to In-Play and Storm. In-Play Oil is a company that I'm not really following because I see better opportunity in other small cap plays, like such as Hemisphere and Journey Energy is another one of our holdings. Storm Resources is a gas play. I'm not interested in gas plays at this point. I've done a number of calculations on them. They don't generate the same free cash flow yields, and you're also playing a potential short-term blip, because if you have natural gas demand, you can always change it to oil. So if you have any heating demand, you have industrial uses for natural gas, it can be substituted by oil. However, anything that's oil, so gasoline and distillates and jet fuel, you can't substitute it with gas. So to me, oil, even in the case of a cold winter, oil has the higher potential, in my opinion, than gas. So that's kind of the reasons why I don't really look at gas companies. I did a valuation on ARC Resources last week, and the free cash flow yield was less than 12.5%. So, you know, it's according to what I'm looking at, it's already overvalued. So yeah, that's kind of my thoughts on that, on those plays. Yeah, so yeah, that's kind of my thoughts on the quality of Surge. I don't know if you had any other, or if you guys have anything to add, or you want to ask. I know Sohaib and Brett, you guys are a little bit active on Twitter on Surge in particular.
Brett, did you have any things you want to talk about in regards to Surge, or are you still with us, Brett?
Oh, no, I just took a nibble. I've been following them for a long time and didn't do too much research into it. I like low decline and conservative or a conventional wells as opposed to shale. So I got a bunch of integrateds and I got a bunch, Cardinal's my largest holding, and that'd be kind of somewhat similar to Surge. So, and I feel Surge is cheaper. So yeah, that's all I have to add. So.
Right on, you betcha. No, that's good to hear, and I know that's kind of what I've been hearing is that people are not putting huge money into Surge, but it seems like people are dipping their toes in there. So I think there is a lot of free cash flow potential here, and if you see oil going up a little bit higher, yeah, this company is insane. And both the deals that they made, they got a little bit of flack for it, but both of them generate enough free cash flow to pay back the entire purchase price in 18 to 24 months. So there's not that many deals like that left on the table, and you can kind of see that the M&A has kind of dried up now because companies don't want to pay 4 to 6x cash flow to acquire these assets. So,
do you know anything about Westlake? That's a private company in the same area, and they're kind of owned by, I believe, the Chinese, and so that's kind of an interesting player in there. If the money comes from wherever, could you see them kind of buying Surge or similar assets to Surge, like in that area?
I'm not 100% familiar with Westlake. I know I've worked close to their operations in Lloydminster, their area-ish. But the place where I see pricing going now, I really don't see much M&A activity out there because the valuations that these private companies are now going to be commanding are going to be higher. There is a lot of private equity looking to get out from their investments from the 2014 to 16 era. So you might see that, but really there's not that much left. I can definitely look into Westlake and look at more of how the assets fit in. But I just don't see Surge doing another acquisition at this point. It's kind of in a sweet spot right now where they have the lighter oil now. They have a little bit of the heavier oil. They're at a pretty good size where, if they start adding more, then you start getting into a little bit of the mid cap conversation, or getting bigger and bigger. So I think they will stay where they are. They might try to increase production organically. Yeah, but that's all my opinion. There's nothing I have to back that up. So it's just what I think. There's a lot of the private equity that's left is not looking to sell anymore. They see the light at the end of the tunnel and they're looking to really cash in on a spike kind of thing.
Much appreciated. Thank you.
So I mean, in terms of how their performance, they've performed similarly to Whitecap and Crescent Point. So just if we can see the numbers here, just to see in terms of why they're superior in terms of free cash flow generation than the other two names I mentioned.
As far as why they're superior in terms of free cash flow, it all comes down to the same thing. Their wells are not declining, so they're not having to put in a lot of this adjusted funds flow back into capital expenditures to try and keep production flat and keep it going. And a lot of their wells are very cheap. You look at the Duvernay and the Montney. The wells are costing $8 to $10 to $12 million. And then you got Surge here drilling wells for $800,000 or $1.5 million. So there's these wells are
There's
basically,
a huge difference between, 10 million to 800,000. I mean, you would think like, so, I mean, if it's really that low, why doesn't everyone just go to, wherever these guys are drilling and just drill wherever Surge is drilling?
the reason for that is because people don't want that. They want the huge high production from these shale oil wells, that come on at thousands of barrels a day. And then, a year later you look at it and it's only producing 100 barrels a day. That's what people want, is like, oh wow, this is a 90,000 BOE company, or they got these monster wells, and not realizing that, hey, yeah, these wells do pay out. Definitely they pay out fast, but at that point, you basically have no production left. So, and then the other thing is that a lot of the land in these in the areas that Surge is in, a lot of the land is already being exploited. So a lot of the land is legacy production from way back that people are now putting water floods in. They're putting polymer floods in. They're putting pump jacks on. They're trying different kinds of solvents. So a lot of companies are not interested in this. A lot of private equity is not interested in this. They want to fund the company, and the company grows production massively, and then they can sell the company to a bigger player like a Crescent Point or Vermilion or whoever it may be. So Surge is more of a company that, if you look at it today, the undervaluation has to be fixed. It will come back to the norm. So short term, it's a great play, and long term, over 2 to 5 years, or even less than that, depending on how long you want to hold it for. This is a company that's going to generate the free cash flow, the stable dividend that you're looking for. And like I mentioned on Twitter, this company has already paid out 2x its current market cap in dividends. So, the dividend means a lot to companies like this. And once they have their debt profile a little bit better than what it is now, I'm expecting to see an incredible dividend that's going to really shock people. And you can then hold it for the share price appreciation, or you can just hold it into the sunset for your dividend potential. And then if oil goes up even higher to 100 or 120 or whatever you have in mind, this, I think the last that I calculated, at $100 oil, the company could buy back, I want to say could buy back like 60 or 70% of the float at current share prices. So, it doesn't make sense. The valuations don't make sense anymore. And I think they will, once we have Q3s from every company, once we have Surge getting out of their deal period and being locked up in there, I think you're going to see short term a lot of return in terms of share price appreciation, and long term in terms of the dividend potential. But it comes down to main thing, that is that investors want the sexy plays, and Surge is just not that. They drill old conventional wells. They go in and they recomplete wells. They go in and they put in water floods, and people don't care about stuff like that. But once they come out with their dividend and their share buyback and their free cash flow potential, you will see interest no matter what, because people like money, and that's what Surge generates. So yeah, there's a couple questions here on let's see here, let's go up. So Meg is a company that I really feel confident in. I bought Meg. It's a pretty big play for me. Their reserve life is incredible. They have spent all the capex to get to the 90,000 BOEs a day, barrels a day, and now they just sit there, and for the next 50 years they're going to just generate cash. So, it's a similar story to Surge again, and with Meg you get a lot of extra benefits. They have, I want to say they have almost $2 billion in tax pools. So all the money that they're generating, they pay no tax on it for the next, I want to say 5 to 6 years. And they have a lot of patents on game-changing technology, like the polymer floods and the solvent injection you know, we saw how fast SAGD came on and really changed the industry. Well, you know, any one of these patents could be worth billions of dollars on its own. And it's a very stable play that they just need 1 year to pay back their debt. And after that, this company is I just don't see why they wouldn't get bought out. This company right now is a prime takeover candidate. They have lots of benefits, and you know, I wouldn't be surprised that there is no MEG within 6 months to 12 months, and it's taken over. There's a question on Cardinal here. Cardinal is a company that is very similar to Surge. It has extremely high cash flow potential. For me, it's all about valuation. Cardinal has run up 1,100%, I believe, in the last 12 months. Surge is up 350%. So, you know, I think that speaks for itself. And I'm very involved with the management at Surge, and I'm close to them. I feel like there's confidence in management that takes time out to meet with investors and really sets the story straight. Cardinal, I just haven't been confident in their cash flow generation. They have these power projects going on that I don't really understand fully. Their management team is pretty, let's just say there's a lot of VPs for the amount of production that they have. So I'll leave it at that. Baytex is again a name that's run up a lot recently. I'm wary of their high debt load. They've come up with a game-changing discovery in the Clearwater, so I would expect that to really boost the share price. I heard a comment the other day on Baytex that with their multi-leg laterals in the Clearwater, how are they really gonna achieve full recovery in terms of the long-term game plan? So that's something that I still have to research and kind of ask around and look into. But Baytex it's just been a name that I'm not interested in. There's too many eyes on it, and there's too many short-term investors, I believe, in it, that the downside risk is a little bit higher for me. Headwater, great company, one of the best managements around. To me, it's just a relative valuation. It's overvalued for what they produce. So, and it's always going to be. There's a lot of interest in that name. So it's just not a name that I would like to hold. I don't see the potential in that name. But yeah, thank you for bringing up these names. This is something I really enjoy talking about, my opinion on these. So we have another comment here on Tamarack Valley, and this is an exceptional name to own. I think they also have exposure to the Clearwater in a pretty big way. So this is a name that I think would be coming into my portfolio sooner than later. Right now, I'm just where I am is I've identified certain companies that I think are going to have incredible Q3 results. So I have a little bit of capital tied up in that. But you know, come mid next month, I think I could see myself doing a little bit of rotation into some of these names like Tamarack Valley, depending on the results of these spreadsheets. And in terms of top three, I invest in what I believe in. So if you go on the White Tundra website, we update our holdings every week. And right now, Surge is my biggest holding. I have a decent sized position in Crescent Point. But my top three right now, I believe, are Surge, Cenovus, and MEG. And I think Suncor, after their recent boost, last week. I think might have broke the top three, but those are the three plays that I'm really interested in. And then I got Hemisphere and Journey in there as my call options, where I see incredible return there and potentially build on them. And
For Journey, you don't see it as, I mean, it's run up about 1,500%. I mean, I think that's the one that's run up the most from all the names. You don't see that, it might have reached a point where it's, a little overvalued now?
So I've got this question from a couple people, and you're correct. Yes, it has run up a lot. It suffers from a low liquidity problem where it's almost impossible to build a position in there. And Journey, I will say that if you're someone who enjoyed the course today, I would say that if you ran your own calculations, you will see that Journey has 1 year of debt to pay back, and once they pay off that debt at roughly $80-$85 oil, they generate enough free cash flow that once they pay back the debt by this time next year, they could privatize the company in 1 year. So I look at that and I say, okay, this is a name that if oil price goes down, there's a lot of risk with it compared to a name like Hemisphere. But if oil price continues to rise or stays where it is, I still see a 8 to 10x potential on this. So it's very undervalued, but it's more of a risky name. So I don't really talk about it as much because it's just unless you really understand Journey and their operations, I think there's a lot of risk compared to some of the names out there. So yeah, so I'll leave it at that on Journey. If you want to run calculations or if you want to run them with me sometime, I'm more than willing to do that as well. There is, I do want to mention a name. Pipestone is a name that I held last year and earlier this year, which has huge potential, but it comes down to the same problem, is that I'm not interested in these huge decline names. But if someone on here is looking for a play like Surge, but you want the unconventional side of things and you want the high production wells, then Pipestone is a really, really solid name, generating really good cash flows. Imperial Oil is on the chat. A name that I'm really not interested in. I've never done evaluation on Imperial Oil. It's just too conglomerated. There's too many moving parts. The whole ExxonMobil thing, it's just not a name. I would rather focus my attention on Suncor and Cenovus if you're looking for that play. I can't even speak as to what kind of free cash flow yield there is on that currently. I could definitely look into it, but I don't see myself investing in Imperial Oil. And then on the service side, I've always liked Trican. It's the only name that I've really ever bought on the service end of things. Is there a lot of potential in Calfrac and Essential? Yeah, certainly, but I see there being a lot of pricing concerns on the supply side, where they're having to pay a lot of money to train people, to hire people for labor costs, for steel and their pumps and equipment, maintenance, etc. And they are not able to pass that on to the consumer, to the E&P company. I'm hearing from Grand Prairie that a lot of service sites that are trying to increase production by even 10% are getting a huge pushback, and that's not what I want to hear when I'm looking at service companies. So there are people bullish on these companies, but I see better potential elsewhere. I have better expertise in the E&Ps, so I'm more comfortable in my valuations on E&Ps. Yeah, I guess let's just leave it at that. I would love to be involved in all parts of the industry, but I find that as soon as you get into the upstream and the midstream and the downstream, you lose the quality. You lose the quality of your own analysis. So the E&Ps is kind of my niche. It's kind of my forte. So yeah, but I appreciate you bringing up these names. And there's a question on here about decline rates. How do you distinguish slower decline or high declines? And some corporate presentations have their decline rates on there, some don't. If they don't, basically you look at the assets. If they're an unconventional hydraulically fractured play, you will have high declines. If you have a conventional, whether it's heavy oil, whether it's oil sands or SAGD, the decline rate will be considerably lower. That's really the base way to put it. And I think as I launch the website and as I launch White Tundra, we will have these sorts of data points available. So on our website, there's a intelligence suite, which is going to be launching next month, and it's going to have like basically a graph showing all the decline rates, a graph showing all the companies and their productions, a graph showing all the companies and their water flooding or what they're doing or their growth rates for next year and etc. So you know, you can go to the spreadsheet, you can run your calculations, and then you go to the website and say, okay, now comes the subjective part, and you can just compare companies on the fly, and you know, just trying to make things simple. So if we can provide this kind of data, it's important, but I think running the valuations part and understanding why the valuations are run how they are is something I would like to pass that on to the investor, and then we can provide some of the subjectivity analysis and some of the other information, which can help really nail down the companies and why they're superior to each other. So yeah, so we're 3 hours in, so I think I'll kind of end things there. If any of you wants to run your own numbers on Surge, I'm extremely happy to discuss that company. So I will have my spreadsheet ready and we can have a discussion. I live and breathe oil and gas, so you know, you want to call me, you want to email me anytime. I'm always open. As far as the course goes, if you have any feedback, I think it's a course that you're either interested in it or you're not. So if you have any feedback on how we can kind of make things a little more smooth, you know, maybe not have it go on as long. Although I really enjoy the discussion part of it more so than just the valuation part of it. So yeah, feel free to email me, call me, and I really appreciate everyone's time and kind of listening in and being involved. You know, this course really goes a long way if people are involved and asking questions. So really happy to see that. I think we're gonna have a test run 3 maybe in a couple of weeks, and if there's any names you want me to go through during the presentation, then yeah, shoot me an email. And yeah, like my goal with White Tundra is transparency, as it says in the chat. Somebody mentioned that is you know, like I think there's a lot of misinformation and there's a lot of stuff hidden with these companies. But I think if we can get people interested, if we can show them that, hey, you know, this company is generating X, Y, and Z cash flow, and it's all gonna come back to you, I think we can get a lot more retail interest. We can get a lot more interest from people that work in the industry, and we can get a lot more understanding than just throwing darts and picking names and then you know, saying I hear these comments all the time about how oh, it's just gonna crash once again. But you know, if you really understand the macro outlook, if you look at the inventories, if you look at where demand is going, and then you value companies, I think you know, I have just about every single penny that I have invested in these companies, and I sleep well at night because you run the numbers, you do the calculations, and you say, hey, you know, even if oil price drops to $60, well, the company is valued right now at that anyways. So there's the risk reward is skewed, in my opinion, in our favor. So yeah, so I'll kind of end it there unless there's any other questions or any other comments.
Just once again to reiterate our gratitude and appreciation. You know, it's rare to find someone that has the stamina to be able to, it reminds me of a Joe Rogan podcast. We hit 3 hours. It's really blessed. Thank you, Shubham. We really appreciate it, and we look forward to showing up to the next one.
Yeah, thanks everyone again, and hope you have a great weekend, and look forward to seeing you at the next one.
Absolutely. Take care.
No, cheers.